Okay, hi everyone. Welcome to the Buyers Table, the FinTech edition. I'm Leandra and I run platform and network here at Forum Ventures. For anyone who isn't familiar with us yet, Forum Ventures is the leading early stage fund, accelerator, and AI venture studio for B2B startups. We were founded in 2014 with a mission to make the founder journey easier, more accessible, and more successful from the very earliest stages. This year alone, we'll be investing in over 55 companies, and we're also building companies from scratch through our venture studio. So if you're a founder or you know one in fintech or any other space, we'd love to talk. So quick context for what we're doing today. This is not a pitch competition. We have 5 early stage founders who are going to present directly to a panel of enterprise buyers, and our judges are going to respond the way that they actually would in a real vendor evaluation. So honest questions, real reactions. This is not investor theater. If something wouldn't move them to act in real life, they're going to tell you that. So I'm really excited to introduce our panel today. We have Patrick Slane, who's the VP and Director of FinTech at CERNs Bank, Joe Mancini, the Operations and Innovation Officer at Middlesex Federal Savings, Jared Robinson, who's the SVP and Director of FinTech at Legend Bank, and Shilpa Bangera, Operating Partner at Gravity Capital and former Global Head of Payments at Adyen. Thank you all so much for your time and for giving your feedback to these founders. We've got 5 companies presenting today. Alexis, will you show the 5 companies? Each company will present for 5 minutes, followed by 5 minutes of Q&A and feedback from the judges. So judges, after each presentation, we're going to do some quick rapid fire questions to really take the temperature of the room. So we'll be asking you to hold up fingers 1 through 4, 1 being not at all, 4 being very much, for a couple of questions that we'll ask, and then we'll kick off the feedback so that you can dive right in with the founders. So without further ado, we're going to get started. Ocean is our first presenter, and I'm going to bring him on stage now.
Yes, thank you so much. Let me try and share my screen. Let's hope that the trial run before did actually work. Cool. Yeah, I have the pleasure to be the first one today. Thanks for hosting. Maybe like the name of the company, Bulwark, is just a German word for bulwark, so quite close. I think the timing is also quite good today. Leopold Aschenbrenner's hedge fund collapsed in the last 24 hours. And I have the privilege to present AI for risk teams, essentially. So how do financial companies manage risk in the age of AI? So I'm going to quickly talk about the thesis and what we're building. I'm going to quickly show you how the platform looks like today to kind of see what we're actually building on. It's, we're past the stage where I have to explain, AI to people or what it brings to the table. Machines are moving from calculation to judgment, kind of human judgment. That's been a big change, right? So we saw in the past, 18 months, especially, that reasoning has become cheap as well. When OpenAI first released their O1 model, like their first reasoning model, it was still very expensive. But since then, the reasoning cost has also collapsed. At the same time, we see that also on the attacker side, it's also shifting. So companies are seeing an increase in the attack surface. So we see this both in financial crime to cyber. It's a pretty broad surface. It also has downstream effects on, for example, vendor assessments or third-party risk assessments. So if there's a high risk that your third party is getting hacked, or there's like a supply chain issue in your installed packages. But the reasoning is also on the attacker side. It's not just internally. At the same time, your risk team is still essentially a human-led organization. And again, it's the entire cost surface is still kind of, it's being determined. We don't quite know what exactly, the costs are on each side of the coin. But of course, it's a massive headache for any organization heading into this perfect AI storm. Maybe that's one thing. It's a fintech pitch today, but risk management and risk detection, threat detection is kind of inherent because the regulators have been, blessing us with a lot of risk regulation, ever since banking has become an issue. But the entire profession will be completely rewritten in the next 10 years. So of course, if you're in a risk team in a bank, your role will probably look different in about 10 years. It will be more automated. You might move to more kind of managerial stuff, or you might be moving closer to management, or you might be moving closer to kind of a first line compliance role. But also if you're working in pharma or just general big tech or big corporation, your risk work will look entirely different. And what we're working on in Bulwark is that we're trying to be one step ahead. So currently lots of organizations are playing around with co-pilots. So how can we like add a chatbot to the people in risk analytics? How can we speed up onboarding, etc. We build for the first day towards actually putting your organization towards kind of an autonomous track. That is still kind of the 10-year roadmap. So if I'm pitching to you as a buyer, we're going to make everything autonomous. Like, don't be afraid. I'm not saying that's going to be the case in 2 weeks or 2 years, but this is where the roadmap is heading. So we're going to move from a very human labor process to a very automated process. And that's going to happen gradually over the next 10 years. So it's going to start with some kind of sanctions checks or some kind of alert investigation towards more complex kind of workflows or just more complex actions, essentially. There's a couple of things that are really hard. So lots of people are slapping LLMs on a lot of tasks and a lot of workflows. That's super easy. Actually having agents running on a long horizon, making sure that the adversarial robustness is also present, that they don't violate policies, and that decisions are verifiable. Those are big concerns, right? Those are also quite hard things to really solve. Like as we experience every week in our jobs. Those are great buzzwords, but just the long horizon and the adversarial robustness is a super hard problem. It's not just LLM built, so LLMs are part of the equation, but also the detection. Yeah. So yeah, the detection layer is also changing. So with the rise of tabular foundation models, your detection layer for cyber threats is also changing now. So it's much easier to deploy internal foundation models to also help you detect threats or other risks within your organization. And maybe just a quick demo how this looks like today. So we usually, if we do an implementation, we deploy like a skeleton of our application here, and we just go essentially workflow by workflow. So we look at particular cases that you would like to solve within your organization, and we take the step by step. We're particularly financial crime heavy flavored. So we're particularly looking at essentially automating your financial crime workflows. And we try to put your kind of things you want to have automated in a secure and sensible kind of framework. So you make sure that you're compliant with all the regulations. And in half a year's time, you can also explain what you did to the regulator downstream. So we invest a lot of time and effort into making sure that we deploy models the right way, they're constrained the right way, that they're also performant. We do a lot of research on agent memory. We do a lot of research also on data memory. So yeah, we're essentially trying to bring together this awesome framework and helping you transform your risk organization from A to Z, essentially.
Thank you, Ocean. Okay, our judges are here. But first, let's do the rapid fire questions. So you're going to hold up 1 to 4 fingers. Remember, 1 being not at all, 4 being very much. So on a scale of 1 to 4, how urgent and costly is this problem for your organization today? We've got a 2, 2, 3, and I think Patrick is a little off screen, so we'll come back to him. Okay, on a scale of 1 to 4, how likely are you to actually pilot or build something like this in the next 12 months? 1, 3, 1. Okay. And finally, how well would this fit into your existing workflows without creating more work for your team? You got a 1, 2, 2. Okay. Let's jump into feedback. You can definitely ask questions or just give direct feedback about what you thought, but please explain your questions or your feedback so that the rest of the audience can hear from enterprise buyers as well.
From my perspective, I think you're early. but I don't think you're wrong, right? I think that banks right now are just not in a place at most institutions.
I think that this is a discussion we're having today at the bank. Um, the challenge I think that we have is similar to some other areas. You've got folks that have been in this space for a while that have done it a certain way that have passed muster with the regulators. Um, and the challenge becomes as we grow and scale within the sponsor banking space, the resource question is always something that's there. How do we replace, is this something we need to add staff for as we add more fintechs to our sponsor banking programs? And so in that event, how do you approach this with organizations you speak to about really starting small? Is this a start small, as you kind of alluded to? And how do you help identify some of these areas within these institutions? Because that sometimes is a challenge that I've seen across some of the banks.
Yeah, so the starting small is something that was always important for me. So I spent 10 years like in risk management, but in a heavy like fin crime like environment. So dealing with lots of teams that were dealing with backlogs in financial crime tasks. So clearing or just triaging alerts. So often we'd approach a team that has, often they'd have like maybe like a half-year backlog with transaction alerts, and we tell them, listen, we'll not try and solve it for you, but we'll try and triage them. So if the regulator comes in like 4 months and they will check what's actually still left, is that maybe the biggest issues are already resolved, right? Because so part of the triage, you want to make sure that like the really hard cases or the really bad cases are already resolved by the time the regulator comes by. So yeah, we do narrow it in the sense of what we pre-build in terms of the agents and the kind of foundation models we bring to the table. And yeah, we try to hatch it a bit because like as Patrick also alluded to, it's an emerging space, and like risk is kind of the best and the worst customer to sell at the same time, right? You have to pick narrow cases where you're not going to you don't want to solve a problem and create another problem at the same time, right? That's what we don't want to do. That's kind of the most important thing, right? Yeah, we start small. I've had the privilege that I know lots of these people, so I understand a bit what their worry is at the same time, right? Is that they have the regulatory deadline they might have to meet, or it's kind of, oh, you have to onboard quicker or whatever. At the same time, they don't want the regulator discussion in a year as to, what did the agent or what did your workflow that was automated, what did it do actually, right? Did it also destroy something rather than just create, right? Yeah. But also maybe to also maybe add one thing on top of this though, right? One thing we do say is though that our system doesn't need to replace yours, especially when it comes to, so we have the cyber and the financial crime track. When it comes to cyber, you need to have additional systems that check for things you might be missing today, right? So you cannot just say, well, we're not looking at it today, it's not in our queue, whatever. It's very likely that the Iranian or Chinese or Russian hacker is attacking your infrastructure today with newly created scenarios, right? So we try to create a little bit of urgency also on the attacker side, right? So it's not just making sure that whatever you have on your table you want to get rid of, there is also, the attacker is scaling, right? So it's a bit of a double approach, but yeah, but it's also part of the sale. So I guess it's also my view as a CEO, of course. So it's not always completely objective, of course. Yeah, that's also how we see the space. Yeah. Yeah. Thanks for your question, Joe. Yeah.
I have a follow-up question to that. What is your clearest ICP from a product standpoint, and where do you think your buyer is very uniquely fitted to that ICP in the next 1 year?
Yeah.
I don't even want to go beyond that.
Yeah. Yeah. Shilpa, it's quite easy. It's either a chief AI or chief vision or chief tech officer who has the tone from the top. The company needs to go towards AI and agents. So someone who needs to move towards an AI first or AI second, it doesn't matter, organization, but they don't have the tech talent. They need help to actually do it in a safe and smart way. That's buyer number one, someone who actually wants to transform the entire organization. Secondly, someone with a headache. So someone who needs to onboard quicker because there's business pressure, or someone who needs to meet a regulatory deadline. So yeah, we have the urgency from business, from really CEO top down, or urgency from regulatory or just revenue. That's the ideal customer. Yeah.
Thank you so much, Oisin.
Thanks,
Next, we're
Leandra.
going to bring Adam onto the stage.
So hi guys, my name's Adam Liu. I spent the past 6 years in commercial credit underwriting throughout various banks and institutions, startups as well, and lived this pain firsthand. So that's why I'm building Credit Quant to essentially streamline and connect the intelligence across the credit lifecycle, from all the way from analysis when the RMs bring in the deal, all the way to when the deal is closed and booked and funded, and the portfolio managers are managing the quarterly covenants and quarterly reviews of the client. So with this problem is there is a lot of fragmented data and analysis that happens throughout the underwriting and portfolio management process. They live, throughout spreadsheets, PDFs, different Excel models, and with each deal and each client, there's a lot of inconsistencies within the kind of structuring of how the data is presented. And then the junior banker or the analyst team typically spends a lot of kind of unnecessary time working through those files, understanding the credit, understanding the client before any real decision is made. And on top of that, once the deal is closed, there's actually very limited portfolio visibility into the clients that are closed. So this inspired me to start Credit Quant, which is essentially a unified platform to bring in all the commercial credit intelligence into one AI native workbench. So as you can see here, we have 7 different products. I'm not going to go into each one, but I'll highlight 3 of the main ones. The first one is document intelligence. So the idea here is that you can essentially upload the entire data room or the borrower file into our Credit Quant engine, and it'll bifurcate the files. We'll OCR every single document and index it so that it becomes machine readable, that an LLM can understand. And typically the first step, and the one that I spent a lot of time with in my career, is deal screening. So before an institution actually deploys meaningful capital, there's a screening part where does this even fit the internal risk threshold of the bank or institution? And typically these are like 15 to 35 different knockout questions that our platform does instantaneously, and with essentially a click of a button. We have predetermined agents that go off and review all the different documents and find exactly the down to the paragraph level of the supporting evidence of the claim. So this allows deal teams to essentially move much, much faster throughout the screening process, which is typically a huge bottleneck throughout the 60 plus customer discovery conversations that I've had at different institutions. Of course, financial spreading, those that work at banks know this whole process. Right now it's super manual in Excel. Our OCR engine does this in less than 3 minutes. You can do historicals, tax returns, PDFs, scans, all of that. And we have the most, I would say, critical thing that a lot of people are impressed with is with the AI analyst that allows you to essentially query within the documents and ask it any type of question. And our entire system is built on trust but verify. So we have essentially every single figure and calculation is directly traced back to the source. As you can see here, we have the source citations, and I'll pull up that exact file. So that way it's not, hallucinating. That way it's not just, indexing the entire LLM database. It's very constrained, and we've built several different pipelines to essentially make sure that the output is grounded in truth. And yeah, with that, the main thing that our ICP, which is chief credit officers and chief lending officers, worry about is trust and safety. So, these are a lot of the times they're underwriting private company financials. So we have all the security measures in place that you see here. And the whole purpose of building Credit Quant was essentially 2 direct business outcomes. First is to allow faster time to decision, which is a key revenue lever that allows you, typically a client is competing and having a request for proposal out for 3 or 4 different banks for the same borrower. So the bank that gets back to the real answer with the approval or not typically wins the relationship. And with that comes the deposits. And the second is just more deal flow, holding the kind of head count constant. And those are the 2 business impacts. I think I'm at 5 minutes now, so I'll stop there.
So I am going to do the quick rapid fire questions, 1 to 4. How urgent and costly is this problem for your organization today? You have 2.5. Is that a half? Okay. Wonderful. Haven't seen that yet. That's a good one. How likely are you to actually pilot or buy something like this in the next 12 months? 1, 2, 1, 1. Okay. And how well would this fit into your existing workflows without creating more work for your team? You're not sure? 2. Okay. Maybe this is what the questions will get at. So I will let you all jump in with your questions.
Hey, who do you see as your primary competitors, and how do you think you're uniquely positioned to kind of disrupt this product space?
Yeah, so one thing that I keep getting on kind of like demo calls or just prospecting calls is, hey, we already have Copilot, or hey, we're testing out Copilot. I think that is probably the main competitor, but I would say the main differentiator here is that Copilot is really more like a one input, one output type of agent. Whereas for Credit Quant, we've built specifically commercial credit pipelines that work exactly how an analyst or the whole entire underwriting process works. So in a sense, it's a lot of it's not like a credit system built. It's more of like a chatbot still at the end of the day with Copilot or Gemini versus a agentic credit underwriting system.
So we're going through this now at my organization, looking through a couple opportunities to assess the right product for us and the right offering. So I think that one of the biggest challenges, it's funny because the opportunities we're seeing are approaching this a couple different ways. One is give us your most difficult, complex problem, your loan. We want to see the borrower with 15 entities underneath it and make this as complex as possible. The other is approaching it saying, let's build trust and start this slowly. How would you recommend approaching that? Because I think both are critical parts. One is, taking away from time, manual, kind of less critical tasks versus the one that's really taking the most time for the team. How do you approach that in your discussions?
Yeah, I think I always propose with let's start slowly and build trust over time. So for example, one institution that we're talking to, they seen kind of what I showed you guys, but they really spend a lot of time, or their junior level employees eat a lot of time with spreading through, multi-entity spreading, audited, unaudited, whatever it may be. And if they can eliminate like 3 or 4 hours every day of that analyst's time to free up doing like more meaningful analysis, that is already a huge ROI win for that institution. So we're just going to start with spreading feature, and then as that builds more and more trust into the system, into the AIs, then we start unlocking a lot of the other platforms. I think attacking it from let's just take the biggest complex problem and try to do everything. It's bound to run into bugs, and it's just going to be really messy. And at the end of the day, it's going to take a lot of commitment and time from both parties, which I don't think is like a good use of time. I think it's better to start small, show some ROI, show some wins, and then let's expand the technical landscape.
That's great. And just one quick comment. I would say keep emphasizing the trust factor, because you've said that a couple of times, and I think that's one aspect of this that the teams, they hear the word trust, and they then start to think of it differently, right? So just one thing to continue to do as you're having these conversations out there.
Awesome. Will do. Thanks, Joe.
Great. Thank you so much for all the feedback. Okay. All right. We're going to go with Gwyneth. Gwyneth, you're going to go.
Okay, everyone. My name is Gwyneth Borden. I'm the founder and CEO of Remint, and Remint is driving higher recoveries and consumer financial health. What are we? We're an outsourced digital debt collection solution focused on financial wellness. We meet consumers where they are to help them repay and rebuild. For many of you that do lending, and that not, I know that you don't do a lot of consumer product specific lending, more around more asset backed things like mortgages. We are seeing higher rates of delinquencies, higher than pre-pandemic norms, and more financial institutions are needing to staff up to meet those needs. And yet many financial institutions still have not invested into technology related to collections. They're very much leveraging call center tactics. People aren't answering their phone anymore, and people do expect a digital experience. And then consumers nowadays are savvier. They want what's easiest, and we're seeing a huge uptick in bankruptcies and debt settlement as a consequence of that. So what do? We do early to late stage delinquency and charge-offs. We can do asset-backed and not asset-backed products. We do the full communication stack: text, email, calls, voicemail drop, and we also support financial wellness. This is just a picture of our dashboard that you have 24/7 insights into the performance of your portfolios. We can do early stage, so we have an ability to do the full communication stack, either driving them directly to your bank portal to have them pay you, or we have our own portal that we can leverage, and we are able to take a more diverse range of payment types. We can split payments more creatively, and we can actually white label it to make it your own interface. And so what's really unique about our approach is it's very much psychology and financial literacy and data driven to drive your customers to make payments. For our late stage, we have a self-cure platform that drives consumers online to resolve debt on their own terms. We don't do preset repayment plans because we want to give financial capability to those consumers to make those payments. We allow weekly, bi-weekly, and monthly payment plans, which I've not heard of another collection software that will take weekly payment plans. We also take a diverse range of payments. You can do crypto, Venmo, PayPal, wherever your funds are. Anecdotally, we see a lot of people using PayPal to make payments, and on average, consumers keep about $216 in those peer-to-peer payment accounts, and they feel like it's free money when they can pay it towards their debt. But the other part of our platform that's unique is the credit building aspect. We have a built-in credit builder at no additional cost. So consumers, when they make a payment plan to repay the debt that they owe you, they can opt into our credit builder product, which is an on-paper loan that basically is based on whatever their payment plan is. So if they agree to pay $500 a month, it looks like they're borrowing $500 a month, and they're able to establish new positive credit on a new trade line, which incentivizes them, because particularly when accounts are closed and charged off, those consumers have seen their credit scores drop precipitously, and they know that repaying the debt in full will not rebuild their credit score. So it's a very big disincentive. We also have personal financial management tools where people can create budgets, set alerts, and make debt repayment plans. Of course, we leverage AI. We have AI agents for calling, for monitoring our security and compliance internally, looking at behavioral analytics and scoring accounts, and supporting all of our communications. What's great for us is that we have this self-resolution platform that allows customers to go ahead and take care of it. We have diverse payment types. We have a built-in motivation around the credit builder and other tools. We have more touch points than a traditional agency because we're in touch on a daily basis, usually 6 days a week. We offer really flexible payment structures. And then 24/7 visibility. We have a portal where you upload your portfolios, and you are able to see performance and activity in real time. And so what is our main advantage? That we are an omni-channel modern approach that takes that off your staff's plate and puts it onto our plate. We also created a product that's really focused on retention. It is highly competitive in financial services. Being top of wallet and staying in the top of the mind of your customer is key, and collections usually breaks that bond. And we create a process that actually supports people when they're in their worst, so that you can regain them as customers in the future should you want to. And then finally, we're very security first. All of our data goes, when you upload your portfolios into our portal, it goes directly into our data vault. It tokenizes that information, and we store no PII on our core system. We are SOC 2 compliant, and we make it very easy for you to have 24/7 access to performance and insights. We even have our own internal LLM that searches our private environment. So that's me, that's Remint, and we are working with financial institutions today. And if we could be a fit for you, I know, again, a lot of you don't do mostly asset-backed kind of consumer lending, but if there is a way that we can work together, I'd love to chat with you.
Okay, let's do the rapid fire questions. On a scale of 1 to 4, how urgent and costly is this problem for your organization today? 3, 1, 1. Shall Biden see yours? 2. Okay. How likely are you to actually pilot or buy something like this in the next 12 months? 3, 1, 1, 2. Great. And how well would this fit into your existing workflows without creating more work for your team? 2, 1, 2, 1. Wonderful. Okay, let's jump in with the feedback.
So maybe just a quick question.
Yeah.
Throughout this process, obviously the sensitivity, I'm thinking as a bank, right? The sensitivity around this process in general, protecting the brand. You want to make sure that the customers treated respectfully and the process goes smoothly. How do you go about, looks based on what you presented, I can probably answer this, but I just love to hear from you. How do you go about protecting sort of the brand and providing a good experience throughout this process? It's a delicate, sensitive process, as you know. What's your thought on that, and how do you sort of balance both?
So our entire product was created around reducing the fear and shame and creating empowering solutions for consumers. So we use an approach that's very much steeped in psychology, financial literacy, and meeting people where they are. So we have, in fact, a Spotify playlist. We have a community where we have a financial therapist where people can tune in and talk about the psychological and emotional effects of debt and money. We have a regular newsletter that we send out that's chock full of like real financial advice and information and tools. We create ebooks on guide to getting out of debt and things like that. So we lead with, we're here to support you, and your financial institution works with us because they care about you. That is exactly what the product that we built, because the reputational issue in collections is obviously the biggest thing that many financial institutions struggle with, because you have rogue collections agencies that are very much commission based and very much focused on the social pressure approach of trying to get people to pay. And we don't take that approach. We take that approach at, listen, we're here for you. We make it easy for someone to indicate a hardship, to, if they need to dispute their debt, to really reach out to us. And we find that people let us know what's going on as a consequence, if their wages are being garnished or things that we would not have known, because you as a financial institution may not have all of their financial history with you. And so we find out additional pieces of information because of our approach. And we get really strong. We get 30% plus engagement on a regular basis among our consumers.
This is a separate platform, correct? And so
Yes.
how do you see, or how have you approached it with your existing banks of, being a separate platform than their primary banking application or something? Do you typically see an SSO out? How do you kind of navigate again, now consumers kind of having two places where they're seeing balances, seeing activity? How do you navigate that?
Well, I mean, like I said, we do for late stage. Most institutions have closed the accounts anyway, so they're not logging into their core system. For early stage, we can either drive them back to your portal and not use ours, or you can use ours. We can white label the experience too, so that it looks more like yours for full outsourcing. It depends on what your institution prefers. We can also do that as well. We can embed ourselves in your digital banking. We're currently integrating with Jack Henry right now, and we are looking to integrate to some other cores, because some of the feedback we got from some of our other customers is that they wanted us connected to the core, and especially when you're talking about early stage real-time account reconciliation.
You may have touched on this in the presentation and I missed it, but do you do more than just it seems like just unsecured consumer debt?
Yes, we can do asset
cards,
back.
you do auto. Okay.
Yeah, we can. Yeah, we do everything from auto to HELOCs. We can do even asset back, like mortgages and things like that as well, or UCC1, filing kind of properties.
And how do you typically approach the pricing model, so that, again, there is, just out of curiosity, from a, making sure the incentives are aligned, you're still being approached. It's not doing like what you mentioned on the collection agencies, which have like a, commission structure. How do you typically approach that?
So we, on the early stage, less than 90 days, we do a flat fee based on overall debt amount that, the volume amount that you're giving to us. For late stage, we do a percentage of collections because that is, more standard for later stage. So that's post 90 days or later. So we really do try to size it based on the incentives. I mean, we're not a typical collection shop because we're a tech company, right? But we still do have hard costs like texting people, every single time you text somebody or send a letter. So yeah, we wanted to make it really, our goal is, we measure not only recoveries, but like, are we seeing like movement in consumer financial health and other things as well?
By the way, great presentation. If I were a buyer, then what would be the KPIs you would share with me pre and post to say, this is the value you bought to what I saw before?
Well, a couple of things. I did, first off, we would actually right away do an analysis of the accounts that you gave us, and we would tell you who we like, where we see like how much we think we can actually accomplish based upon our analysis of looking at the accounts, the state, a variety of factors that we're starting to build on our side, so that we'd at least level set up front and give you that information. We'd also identify accounts that we feel like you might want to give special attention. Maybe the person's severely elderly and there's something misalignment, because we actually get data from TransUnion and others to really look more deeply into the profile of that consumer, to be able to provide those sort of insights to you. But our metrics are engagement, actual payments, time to payments, recovery, movement and adoption of and keeping of payment plans, and then also like actual trying to get them to use or taking advantage of financial tools or financial wellness resources.
And do you use other so there are the credit bureaus, right? But if you look at even them, for credit viability or for repayment, you look at other factors as well. Like, for example, your drivers, your driving history could add as a point. So do you even take those factors into account?
Yeah, so we actually, in TransUnion, we get a whole host of data about people, who they work for, liens that they might have, family members. We're trying to really build out a picture. And that's how we'll notice things like, I had a great example where we had a Army veteran who was 78 years old, 2 years ago, took out a credit card and ran up $16,000 in debt, owns 2 properties, but also has 2 small liens against his property. So for like water and garbage. So that was, for us, clue phone, like there's something going on here. This person might be suffering from cognitive decline, or maybe they have a relative taking advantage of them. And so we're pulling all these different points so that we can actually see and flag things that we need to notice.
Okay, thank you.
Thank you so much for presenting, Gwyneth. We're going to bring Sharif back on.
So, good morning or afternoon, depending on which time zone you are. Let me start off by reminding everybody, in 2024, about 100,000 people lost access to their money. Not because a bank failed, but because nobody could prove that the ledger matched the bank account. The gap was in the tens of the millions of dollars, and it took a bankruptcy court to find it. And that failure had a name, Synapse. And it changed how everybody on this table works at the moment. And this is why I started Naya. I'm Sharif Kozman, founder of Naya. I also chaired risk and compliance on a board of a microlender with 500,000 customers, in which I've watched finance teams spend days every month trying to prove money moved the way the systems did. And before that, for almost 2 decades, I built software and for payment processors and fintechs. And it's usually the same story over and over again. So give you a daily reality that probably most of you know, money moves across systems that don't usually talk. Payment processor says one thing, the bank says another, and an internal ledger says the third. Fees are split differently, dates land in different time zones, and someone in finance has to make all of those agree by hand in a spreadsheet and under audit pressure. The expectation now is a daily proof, yet the tooling remains a monthly Excel. So Naya is a non-custodial reconciliation platform and a programmable ledger. We help finance teams prove that what happened to the money across disconnected systems, what agree and what doesn't, where the evidence came from and what requires actions. We never touch the money, but we do prove it. And we do this in 3 steps. We ingest raw data from banks, processors, ERPs, ledgers, and messy exports. Then we do normalize that through column auto detection, fee splits, parsing the dates, transformations being checksummed, and then we reconcile. We do first our machine learning algorithm does deterministic rules, and then our AI proposes the fuzzy matches with confidence scores and reason codes. The high confidence ones gets auto approved, and then exception queues with suggested fixes, and then everything lands in an audit trail. Across almost 3 completed design partner pilots, we've reached up to 99% transaction matching accuracy and reduction in reconciliation time for about 96%. And in one case with a partner, the month-end close went down from 14 days to 4 hours. We're currently now live on Naya.finance, so anybody can go and test by uploading a couple of files and see how they matched. We're already SOC 2 Type 2 certified. And there's one part that I was, now when I know that most people are from banks, so I wanted to your reaction to. Our customer today and our user is a fintech. They do run Naya to close end of month. But the artifacts that we produce are daily proofs that the subledgers, the FBO accounts, and the bank statements agree line by line in an exportable evidence. Those are exactly what the type of evidence that sponsor banks now demand from every program. They require trust but verify, and for that, they need a verification layer. Same evidence, 2 different sides. This is why reconciliation is our mechanism, but proof is our product, and trust is the consequences. So from that, I would love to ask the table 2 questions. One, if the verification layer gets bought, does the bank buy this directly, or does it require contractually from the fintech and let each program bring its own? The second question is, beyond SOC 2, what kind of diligence do you need to see before the program runs on you with your bank? And that? Thank you.
Okay, well, you already posed the question, so I don't need to do rapid fire. I think you'll get more out of your own questions, so I'll let you all jump in and answer.
Yeah, great presentation. I think you nailed it, especially in the beginning part, just emphasizing the importance of this within this space, right? What I've seen, and maybe before I get to your questions, how do you address so let's say it's never a linear process, right? So you have the fintech that maybe wants to approach it as an FBO, or they want to go on core, and they want to either own the ledger, or the bank wants to own the ledger, and there's all this in between that kind of flows around. Where does it matter where this sits? Is this something that, because we're actively looking for something like this at the bank, and the way I would see this is the bank sort of owns this. We just connect the data points from the ledger of the fintech into Naya, and Naya does the reconciliation for us. Is that how you would see this as well, or is this? I mean, could it be versatile enough where it does sit with the fintech, as you mentioned, and the bank sort of approaches? I guess. Can you answer that question? Any thoughts?
Yeah. That's a terrific question because I come from an enterprise software background. This was part of the design in within Naya from the get-go. It does work in both ways, either as the fintech's primary ledger, where the bank gets access to it, so it can audit and have access to all the transactions and the logs and the evidence of the reconciliation, or it can be part of the bank's program where the fintech access it and use it as its own secondary or shadow ledger in place. And the way it's being implemented and designed, it comes even in 2 flavors. One, either as a SaaS-based flavor where the fintechs can just onboard and connect their internal systems and the third-party data sources, or it can be privately deployed within the premise of the bank or the institution. It has been designed like this from the get-go. So it goes both ways.
Thank you.
How do you handle a sponsor bank with, 5, 10 plus fintech programs? Maybe some have ledgers, some running directly on the bank's ledgers, maybe multiple instances. Like, how do you span across all of those while still having a master bank GL, but then various bespoke arrangements as is very common in banking as a service?
Yeah, so because we're not a banking as a service provider, actually we try to fix the problem that BaaS providers did cause a couple of years ago. So we have three main components to the platform that they scale as per digital. One is our own double entry programmable ledger. So that's a ledger that is built on debits and credits, not a database. And this gets provisioned per fintech or per use case. So in a case, if it sits with a fintech, that this is the ledger that they use as a source of truth in connecting with either one bank or two banks or three banks, depends on their program. The other part is our reconciliation engine, which is isolated from the ledger. What it does, it uses the third module, which is our data connectivity. So currently we have data connectivity through most of the US banking system through Plaid, and then we're adding other connections through the payment processes like the Stripes, the PayPals, internal ledger, and so forth. We pull all of this into our data normalization engine to unify all of this. We pick up the unique transaction IDs and so forth, and then we run through that. So in that sense, we can work with hundreds of different use cases at the same time, and everyone is isolated. I hope this answered your questions if I got it right.
Yeah, it does, the modularity of it. And second quick question, how would you just quickly differentiate yourself between Trinitech, AutoRec, and like some of the other existing players in the space?
So I would even add two more, which is Legend, Modern Treasury as well, being in that part. So every company of those are trying to tackle kind of the same problem from a different angle or from a different view. Most of them are there for end of month close and at the CFO office stack, while we run as an operational platform that is on the day-to-day basis. So we do reach almost near real-time reconciliation if the data is accessible and in real time. That's one part. The other part is our reconciliation engine has been built with the fintech use cases in mind, unlike the other use cases or the other companies. To give you an example, we do support one-to-one transaction matching, many-to-one, one-to-many, ones that would have a unique ID identifier for matching, ones that don't, which happens in the case of buy now, pay later across different payment channels, for example. Time lag. We have one case that for mobile payments where there's a settlement is T plus 30 and T plus 60. So in that sense, we do cover a variety of common fintech use cases for companies that want more partnership with sponsor banks to be able to cater to, and for the banks to be sure that whatever is happening on the fintech side does not cause any harm to their customers, because at the end of the day, they are the charter owner that handles most of the liability.
You're basically trying to solve reconciliation from two different directions, right?
Yes.
You're trying to solve it from fintech has a ledger, they submit data to you for you to be able to reconcile against into somewhere, whether it's a GL or an FBO on your account or on your like core ledger system or on your GL system.
Yes.
Then from the other direction, you're coming from, this is what the Fed says. How do you reconcile the Fed against the Fed or the payment networks or whatnot? Because they both merge at that FBO.
Yes, and they need evidence.
Layer. Correct. So like, is your platform then able to, like, I could just send you my Fed statement, and you can pull that in, and you could pull all the fintech's data in, and and the card network data in, to be able to say, like, this is the source of truth. This is the place where, like, True. This is the amount you should have in your FBO account, your omnibus account, each of your settlement accounts at the end of this day for ACH Wire, RTP, FedNow, for, MasterCard, for Visa. Is that what you're saying?
Yes, yeah, true. And we with a unique edge that no other company has so far is that every company that I've seen so far treats reconciliation as a two-sided story. We treat them as a chain of events. So this is why we support not just two-way reconciliation, but three-way and four-way. We treat reconciliation or transaction matching as an event matching, not just value-based, because in lots of cases, in the case of the payment networks, for example, the amount is split into a fee and a principal. So a $97 plus the $3 transaction fee is the equivalent of $100 on one of the other side. So the 97 from the network side is equal to the 100 on the other side. And this is where we be able to see the entire flow of money, and we can visualize how the money moves from one entity to the other and match all the events together.
No, this is a really robust conversation, and I will definitely connect you all offline to
Sure.
continue. That
No,
this
no.
is just the start of hopefully something much longer. But I want to make sure that we have time for Idan, because he's certainly a great person to end us on. So Idan, I'm going to bring you onto stage, and Sharif, thank you so much.
So I'm Idan Bardov. I'm one of the co-founders and CEO of Heka Global. And what we deal with is consumer fraud, specifically within the segment of financial services. And I'll take our time to review three things. So first and foremost is, what is the business impact that we deliver to banks and online lenders in decreasing fraud losses? The second thing is, what is unique about Heka when we compete with LexisNexis, Socure, or CentiLink? And thirdly, we'll look at some evidence, so case studies on the actual impact of working with Heka. So our objective is to reduce AI-driven fraud losses in financial services. So we plug into KYC processes, such as when you need to open an account, maintain a profile update, or issue credit, and figure out whether there's a synthetic identity, an account takeover, or an impersonation. This has been like blowing up all over the news. We can also see it in public forums right now. So for example, Klarna reported last November that they've lost $50 million because of a Klarna glitch, which is a mass impersonation attack that they've sustained. We already work with dozens of financial services. That includes PayPal, Corner Bank, Barclays, Zolve, Mudflap, and dozens of others. And we're also available through the large orchestrators like Oscillator, Tactile, GDS Link, Authentics, and the other folks. Behind us is a team of 35 people that are coming from financial services from one side, and the other side are folks who are actual special forces. This is Israeli intelligence, SAS, and Delta Force folks. That includes former fraudsters that did it for good purposes, for homeland security, in order to find new fraud typologies and fight fire with fire, as you'd like. And this is also backed by financial services. So we have raised our Series A last year. This was led by Barclays. Almost 80% of the capital came from actual customers of the company, and the deal was underwritten by Winder Venture, which is a specialist in data services. So let's talk about what Heka actually means. So Heka plugs into your consumer lifecycle in three instances. One, when you try to open an account, and you want to make sure that you have an account with JP Morgan or with Barclays or with Basseg. The second one, when you try to change information, so if you try to update your phone or email, which is a cause for concern that there is fraud. And three, when you try to originate a product just to make sure that you're actually who you are. And we analyze information that is input into these triggers to make sure that you are who you claim who you are, that you are not a bad person, and that you have good intention, as much as we can see from our network or of former fraudsters. The way that customers use us is very, very simple. API integration based on an AWS cloud. All we need is a name, date of birth, of phone. We do not need SSN, so this does cover thin files. We then process all the information online, and we spit out, so the product that you get is a score that indicates the level of risk. So 0 to 100, and an explanation so you could be defensible if the regulator asks, why did you reject a specific consumer? I pulled some results literally from this morning of working for one for a consumer, and you can see the correlation between Heka's score and loss rate that we see with clients. So the higher that we score an account, actually the more likely that this account is to turn out into fraud. Now, what is unique about Heka is this is not bureau-based. It's actually driven by 3 net new data sources. So we look at your digital presence like social media, using Amazon Prime, Spotify, Netflix, etc. We actually have direct access into darknet breaches. We're part of fraud groups. They don't know that we're there, and we see whether credentials were breached. And we plug with non-reporting collection agencies to see first-party fraud typologies, and we source it into our modules. Now, just to wrap up, it was an actual case study. So this is from our work with PayPal. You can see that the financial impact of HECA really sets us as a new gold standard. And when we were plugged into a profile change, we were able to achieve almost a 98% accuracy and to save on average $5,000 per block, which made us one of the top vendors in this space. So this is HECA in a nutshell. And now I'm open to any questions you guys may have.
So on a scale of 1 to 4, how urgent and costly is this problem for your organization? 2, 4, 2, 3. How likely are you to actually pilot or buy something like this in the next 12 months? 3, 3, 2, 2. And how well would this fit into your existing workflows without creating more work for you or your team?
Yeah, I can start real quick. Great presentation from everybody today. Thanks, Sidan. Just one quick question. So throughout this process, right? So you mentioned you kind of plug into the KYC flow. So we obviously have existing KYC waterfalls today. Where do you sit in that process? And one thing to keep in mind is managing cost, right? So as we go through each checkpoint and the customer, the applicant goes through that process, at any point in time, if it's going to become a decline, we would like to stop it there and not have to have the person continue and incur costs for the bank. Where do you see yourself in the process in HECA throughout this? Is this something you sit towards the end of the KYC process? And where do you envision sort of cost-wise? Do you offer the same sort of flow where you can sort of stop along the way, or is it continuous throughout all the checkpoints?
Yeah, absolutely. So you want to optimize for cost and ROI. The typical setup is we're triggered after a credit bureau check has been cleared. So for example, if you can use Experian, TransUnion, or Equifax to say, this is a very known fraudster, or this SSN doesn't even exist, just stop there. Like you don't need anybody else. This is more of enough reason. If they clear, then we're typically triggered as a second layer within your waterfall. Now, also this layer should unpack into like multiple solutions where you want to put HECA specifically within this set of solution relates to risk appetite, how much friction you want to create, and then also on retro studies showing precision and the financial impact of using HECA. We do see that we are typically top of funnel because we are able to catch the basic frauds that other competitors can, as well as the new age fraud that we covered, like synthetic identities, in one go. So that's more cost effective.
So what would you say to someone like me who would be like, well, we already have Socure, we already have Sardine, we already have someone else who does all of these things. How would you differentiate from that?
First, I will ask you, do you still have fraud losses?
Sure.
Yes. Okay. So let's start with that. So what I would do, I'll try to prove value. We'll do a retro studies that you ran through Socure and Sentinel. That's actually what we do on a daily basis. And I'll show you that not only that I can catch what they can, I can also catch new fraud typologies. And then I'll show you through like math and data that if you will replace HECA with Socure, not only that we're going to be competitive on the price, you're actually going to reduce your fraud losses.
Are you saying that you're trying to get fraud losses to 0? Because I mean, the correct answer most likely is that like if you have fraud losses of 0, then you're too restrictive.
You don't have a live product.
You shouldn't have, yeah, exactly. Like you shouldn't
have
have the number of acceptable fraud losses to a bank is not 0, right? Like you have to be willing to take some risk. You have to be willing to do some things. So like, what do you view as an acceptable fraud loss amount from HECA versus like a Socure or whatnot? Like, what are you seeing as being an incremental benefit that's still a non-zero number?
Yeah, no, that's obviously like a straw man for what I was saying. I was never saying that you need to decrease fraud losses to zero. I was saying quite the opposite, that you want to optimize for flow. So let's just be accurate with the verbiage here. What I'm saying is that we want to reduce fraud losses by detecting new typologies that are outright fraudulent. Now, where you place this, so as you've seen with a correlation between detecting fraud and deterring like healthy business, is based on your risk appetite. So most clients use HECA by putting in a score that everything over 80 is basically blocked. And you've seen the trade-off that roughly when you put a score of over 80, then you will catch 7 out of 10 fraudsters. You would still let some fraudsters in. You will still have marginal cases that you would lose business. But what it boils down to is really a table. We'll do a breakdown where like each micro dial of the score, how it affects your business. And then we can do a calculation, right? So if you give a loan of $10,000, your APR is 10%. I can catch 70% of the fraud cases while 3 slips in, or you want to catch 90% of the fraudster, but you will lose some healthy business. You can find actually an harmonic mean of exactly where you want to be. I completely agree that, I mean, your fraud loss zero is very easy. You just shut down the business. So you do want to let some fraud in. Also, there are very sophisticated frauds that you just can't prevent. There are frauds that are literally impossible, like first-time, first-party fraud. I can't read people's mind. That's impossible to do. But you can definitely take the technologies that we have right now and push it further. So I'll just give you one example that is not done, not by LexisNexis, not by Socure, and not by Sentilink, is to see whether you have history over time on social media, not just that you have a LinkedIn, but the fact that you have Instagram and Spotify and Amazon Prime, and you've used it for the amount of years that you're claiming to be associated with your age. So having this timestamp history is virtually impossible for a fraudster. So if you're claiming you're 38, we want to see, at least 10 years of using online services. And this is like a net new technology that just really catches the bad guys without disrupting the healthy business, which of course is the most important piece when you're running a lending or a financial services activity.
Thank you so much, Idan, for sharing with us. And Shilpa, Patrick, Jared, Joe, thank you so much for your time and some extra time. We went over a little bit, so we really appreciate everyone joining us. And for those in the audience, thank you for joining us as well. I hope you all have a wonderful day, and I will make sure to make the appropriate connections offline so you can continue these conversations. Take care, everyone.